Welcome to Consumer Lending Perspectives, a podcast where we talk to financial industry leaders about trends in consumer assets, underwriting, performance, customer acquisition, fraud prevention, liquidity, and more. Hosted by Jeff Bogan, CFO at Upgrade and FinTech veteran. This show delivers key insights on the topics that matter most to financial executives.
Welcome back. I'm your host, Jeff Bogan. Today's guest is Steve Bugg, CEO of Great Lakes Credit Union, a $1.4 billion credit union headquartered in Illinois with over 100,000 members. Steve started his career in banking and then spent quite a bit of time in telecom and then decided to come back to banking, which we want to talk about on this and how that happened. You've had multiple leadership roles within your organization. And so, Steve, welcome to the podcast. Very happy to have you.
Thanks for having me. Appreciate it.
So let's start with that transition that everyone goes through, banking to telecom and then back to a credit union. How did that happen?
Great question. So banking was a great foundation from learning the basics of business and management and leadership. But I got to that point, I'm looking at that career ladder. I was much younger then, thought it is going to take me a heck of a long time to move up. So telecommunications was newer at the time. It seemed exciting. So I took the jump and went into telecommunications back in the paging days prior to cell phones.
I remember
And
that.
stayed through cell phones and had a variety of roles in the field and at corporate and a multitude of companies. And then an opportunity presented itself to join a credit union. And at that time, didn't really know a lot about a credit union. I think I had a credit union account when I was little from my father's employer. And so the CEO was newer to the credit union I was joining, but was looking for somebody that had some financial services experience. But she didn't want somebody that had come right out of a bank or a credit union, and was looking for somebody that had that experience that would complement her experience. So my sales, marketing, distribution experience fit well. And so she was willing to take a chance and give me that opportunity to join the credit union, and gave me that opportunity to learn about all of the different functional areas. She promoted me over my 11 years at the credit union I came from, which prepared me well for the CEO role when I joined Great Lakes Credit Union about 8 years ago.
Yeah. Well, you're well known as one of the leading credit union CEOs. One of the things that I know you like to talk about is community and your focus on the community and helping individuals with their financial issues. I think that really differentiates credit unions, frankly, versus other institutions many times, but you guys are really doing a great job at that. What's your philosophy around that?
And that's a great segue into Great Lakes Credit Union, but I also think it talks about my background. And what initially drew me to the credit union was the people helping people philosophy and that mission-based work. And so at that credit union, we really leaned in and developed that model. And so when I came to Great Lakes and interviewed with our board, they really wanted to focus and get back to the basics of what makes a credit union much different than other financial institutions. And really were focused on someone that could engage in the community, be active in the community, but redefine what that strategy was. And so fit my background perfectly. And so we've worked hard over the last 7.5 years to really focus on that mission-based work. And my philosophy is it has got to start at the top. So if it's not a strategic focus for the board of directors and for the CEO, it will not work going down into the institution. And so we've worked hard on building around that mission-based work. And luckily, in 2019, we merged in a small credit union in the city of Chicago that had a HUD-certified counseling program and also had a foundation. They were very, very small, but when I talked to the board about merging them in, some of the board members were like, gosh, that's really small. Are you sure you want to spend that time, energy, and effort? I'm like, yes, because we can take the HUD-certified counseling program and the foundation to scale and use that as really our lead in to how we're unique and different. And I think I was newer at the time, and the board's like, all right, it's small, let him do it and see what happens. But that was really that starting point for us as an organization to really start separating ourselves out. And then COVID hit. And although COVID was bad for us, because of a lot of grant money that was available, it really allowed us to amplify our HUD counseling program and really utilize our foundation to help not only credit union members of Great Lakes, but the communities that we supported. So we hurry up and ramped up our counselors, got them trained. And so we started really even leading in our marketing messaging on how we were helping the community in general and how we were helping our membership, which really started kind of bringing full circle how Great Lakes Credit Union is unique and different. And then the products and service we have were tailored to support that marketing messaging, and we've continued to just amplify over time, bringing that philosophy to scale, and then also getting our staff to support the initiatives, the board certainly as well. But it's been a great way and a great platform for us to really identify who we are. And again, while we're unique and different, knowing that we still have to have the correct mix of products and services and support to serve our
Right.
over 100,000 members.
Right. How does the foundation work?
So our foundation is a public charity. So it operates independent of Great Lakes Credit Union. It has its own independent board. And we have an agreement that they provide our philanthropic services. So they provide our volunteering, our give back, also our financial literacy and counseling programs. And so that really opened the door for us to work with other funders and other nonprofits that was not possible when it was directly under the credit union's umbrella. And so it has its own executive director, it has its own staff. Certainly, Great Lakes still supports it financially, but not at that same level as when it was under the credit union.
No, that's fantastic. And I'm sure it's an attractive proposition for your employees, right? I mean, at the end of the day, people want to be able to give back to the community in a way that's differentiated from, frankly, a lot of the larger corporations that are leaving these communities.
Yes. And from the programming that our foundation focuses on, it really brings full circle what the credit union's philosophy is, but it expands that. And so for a lot of nonprofits and other funders that could not work directly with the credit union, they then can work with the foundation in support of the programming that the foundation offers because it is an independent entity from Great Lakes Credit Union.
Yeah, no, that makes a lot of sense. And then back to just the balance sheet. We can't talk about a credit union without the balance sheet. What are the growth areas that you focused on? You've obviously been CEO since for 7.5 years. It's been some pretty interesting times. The last three with COVID and the rate hike cycle and the banking crises that have happened. What has been your focus really over the last few years? Because you have been able to achieve growth in a profitable way.
So our focus when I first started at Great Lakes was really to focus more on our membership and grow organically. And so making sure that we had that right product mix for our membership on the lending side in particular, and then certainly making sure that we were properly priced from a rate perspective, both on the lending and deposit side. As we started to grow and really focus on our membership and deepening that relationship, we then looked at the opportunity for partnerships, and partnerships to us come in a multitude of ways. So we would partner with other nonprofits and look at how we can serve underserved markets. We partnered with other like-minded organizations, and over the last couple years, brought in some other credit unions through mergers. We acquired a branch downstate Illinois from another credit union. And so kind of took that organic growth, amplified that with some merger activity and an acquisition, and then really positioned ourselves for the future. And so to us, it's just not a single focus. It's what's that growth strategy, but it has got to make sense for us and for our membership. And then also we've decided to go the QSO route. And so that's created opportunities for us to stand up a couple wholly owned QSOs, Mortgage Forward, which is a mortgage origination and servicing division, and then also GLCU Insurance Services, which are purely insurance products and services. So the move of moving them from the credit union to the QSO gives us the ability to originate and sell and offer a wider variety of mortgage products, not only to our members, but to others as well. And earlier this year, we purchased an origination company in the Southeast that's now in Mortgage Forward, which has expanded the reach. And so the opportunity there was really looking at originating mortgages and then selling those for income. And then mortgages that GLC would like to add to our portfolio, certainly we would service through that QSO as well. Going back, though, a couple years ago, we got out of indirect lending. So our indirect portfolio was very, very small. We focused on consumer, direct lending, unsecured lending. But we also got stuck when rates changed with a large concentration of mortgages. So
Yeah.
part of the opportunity to move that under a CUSA was we don't want to add more to our balance sheet. We want to be able to diversify. And so we still want the income so we can originate, sell those off, bring that income back in, and still be able to serve our members and people in the community on the mortgage side. And again, through the QSO, a much wider variety of mortgage products than we offered through Great Lakes Credit Union.
So just on the mortgage acquisitions and the new businesses that you set up, was that more of a way to acquire more members, or is it more to be able to offer mortgages to existing members, a combination of both? What was the philosophy there?
So the philosophy was to offer a wider product suite to our membership, but also to really look at it as a pure mortgage origination shop that would drive income through the QSO back into Great Lakes Credit Union at a reduced cost structure than what we were carrying under the credit union umbrella. And then also phase two is to be able to offer our products and services to other credit unions that perhaps are looking for a mortgage opportunity for their members, or even smaller community banks that are looking for mortgage products and services, but don't want to invest in starting that up under their own organizational structure.
Yeah. So back to members, you're probably talking to members every single day, multiple times per day. And you said you listen to your members and what they want. I mean, what do they want right now? What are their concerns? I think there's a lot of noise around the consumer right now. The government shutdown, the lack of data. There's kind of a bad jobs report that came out of ADP today. The economy seems a little shaky. Like what are your members telling you today? And then therefore, what are you focused on next year to be able to make sure that you can meet their needs?
Yeah, great question. And so I think it's important to understand that we are a low income designated credit union and a community development credit union. So over 51% of our members are low income. So those members are very challenged right now. And so what we've seen is the drawdown on their savings so that they can live paycheck to paycheck. And so those members are really needing that opportunity sometimes to bridge that gap between paychecks. So we have a couple great products that help them bridge that gap. They're small term type loans that will help them until they get that next paycheck. So we certainly have seen an increase in small dollar lending at affordable rates to help those members. But on the downside, we've seen they've really pulled all of their savings out and needed that to live on. And so the other side of the membership, because we are based in Northern Illinois, and so the other segment of the membership is more mid-market and upscale, they seem to be out purchasing. We see the card usage. The challenge is they're starting to now start looking at loans again. So auto is coming up. Still unsecured is very important for that segment, but higher dollars of unsecured. And then we find success also in auto recapture programs. So as they went out over the last several years and took advantage of some good programs that were offered, they're looking to bring those back in, where now as rates start to come down, we're more competitively priced. And I would say because of our mortgage business a couple years ago, our loan to share got up to 120%. So we had to slow down on the lending. We're down to a comfortable 90%, where now we can price a little bit more competitively. So we're seeing really an uptick in small dollar, some unsecured, and now we're starting to see uptick in direct auto as well.
How do you on the low income and the small dollar loans? I think that's an incredibly noble business to be in. There's so many predatory lenders out in the market. How do you educate your low income customers about financial services so they can make better financial decisions? And then how is your product structured in a way that is frankly better for the member than going to getting a payday loan, for example?
Yeah, so certainly the key driver is having really affordable rates and rates that are significantly lower than what they would get from a traditional payday lender, but even from some online lenders. And so part of it's rate driven, but we really focus on that financial literacy aspect as well. So we have FISEP certified counselors in our financial wellness centers or our branch network that can provide free of charge budgeting assistance. They can look at their credit report to see if there's a way to maybe realign some of their debt. They can suggest alternatives to perhaps things they've been looking at. And so a lot of our members really look to us as their financial advisor. So our staff has become accustomed to working with them. And then for those that are more into home ownership or savings or foreclosure prevention, that's where our HUD-certified counseling program kicks in. So we try to really be that advisor for our members, and it is interesting. So we have a good digital platform, but I'll look at the stats. I'm like, my gosh, why are people stopping in the middle of the process, right? What's wrong? Is something broken? What we find out from talking to the members, they're like, no, but I want to talk to somebody at the credit union because I want to make sure that I'm structuring the loan correctly, I'm getting the right rate. So that's where our agents over the phone or even online through chat or our great financial wellness branch employees can get involved to help those members. And so it's that balancing act of making sure that we're educating them on the products and services that we have available and that we do have products that can help them, whether they're getting an auto loan, whether they're looking for a short-term loan, but really educating them on you need to look at rate, you need to look at term. And I think a great example of that, two things. One is with the recent federal shutdown. The state of Illinois, although they were federal employees, said, we have a lot of federal workers in the state of Illinois. We need to help them. So the state reached out and said, would you offer a discounted loan to federal workers for a period of time that would help them? And so we did, and we offered it at 0%, 90 days to first payment, and amortized it out over 24 months. And so we had a lot of our members that are federal employees that took advantage of that. But through the state reaching out also to federal agencies, we went on site to courthouses, the VA, other places that federal workers work, and were able to gain members through that program. And in 2 weeks, we funded 650,000. Now it is 0%, but I will say the state of Illinois kicked in deposits to match that for up to 3 months at only 1 basis point. So we can take that, invest that for 3 months, make a good return, and we're still helping the community, we're helping the member, and gaining some new membership out of that as well. So I think that's a good example of credit unions and our size of a credit union that can pivot quickly and have those good partnerships and relationships that when tough times come up, this is how we're helping those folks.
So how, I mean, credit unions are not known for being the fastest moving companies out there. How do you have build an organization that can do something like that in such a short period of time? It's incredible. I mean, those are the types of things that startup companies do in terms of the ability to launch new programs quickly and be open to it. How do you set that culture internally as the CEO?
Yeah, and I think again, it's the support of our board, right? They support that type of leadership, and they want to make sure that if there's a need out there, we're addressing it. Now, are we addressing it smartly? What's the structure around that? but I am blessed with a great team, right? They'll roll up their sleeves and they'll figure out how to make it work. We have a great project management team. We have a great team that can work on the systems. So when these opportunities come up, we've learned that we're agents of change. We need to jump in quickly and we need to pivot. And if we're going to fail, we need to fail fast, fix it, and then move on. And so, numerous opportunities through COVID, through this government shutdown, and through just day to day operations, we find that controlled chaos at Great Lakes Credit Union works best for us. We are not an organization that thinks really, really long and hard about things and pondering them for months and months. We want the facts, but we want to make a decision and we want to move forward. And that has helped us over the years. And that has helped our staff because we've had to bring them along the journey as well. That when these opportunities come up, we need to take a look at them, vet them. And if it makes sense, we need to go to market pretty quickly. And again, if I pivot to AI, we were a leader on putting an AI assistant on the front end of our contact center, who today, Olive, she answers all of our incoming calls and handles 60% of them from start to finish without human interaction. And
That's
so I think this
amazing.
strategy has worked well for us, but you are exactly right. Our industry is not always known for being quick and nimble, but I am seeing that change as new leadership comes in and board of directors look at the business and the evolution much differently. And I go back to my telecommunications experience. And I think with technology and the importance it's playing in our industry now, we're starting to catch up to other industries that embrace technology a lot earlier than the financial services industry,
Yeah.
and especially credit unions.
Yeah, no, that makes a lot of sense. I mean, as I was thinking, when you were talking about small dollar loans, the challenge I think with them is the operating cost of delivering a small dollar loan, and then you have credit. And it sounds like you've taken a kind of a nuanced approach where you're investing in automation to reduce cost, but you're spending on these advisors that probably improve the credit side of the house. And so, as you think about your ability to deliver that product over time, how do you view the future of automation and AI tools versus the hand holding? And how do you manage that balance to basically have the lowest credit losses you can, but also deliver the product at the lowest possible cost? That to me is the future of finance is being able to deliver better products at a lower cost, which is going to drive positive selection on the credit side. How do you think about that?
Yeah, and so we have two different strategies, and they will be blended together over time. So we offer a product behind our mobile app, and it's based on member behavior and some proprietary information through a partner we work with, but it is all 100% automated. Couple clicks, you apply for the loan, and it's an unsecured loan. You're approved, and then it's funded directly into your account. We don't touch it. It's all automated. And that has really worked well for us over the last 3 years. And so we're looking at that model and saying that has really worked well. Our losses are minimal on that type of a product. And then on more of the traditional small and secured loan that we've used in some underserved communities, we're using that to say, all right, how can we automate more of that versus having that human interaction in the future as we build out what's the infrastructure, the underwriting look like? And what we're experiencing is trying to work in the ability to provide some financial literacy because we have better results, to your point, when an employee is providing that financial literacy to them. So somehow utilizing the human aspect in with the automation. So the loan itself could be automated, but we have that wraparound service to provide that financial literacy and also looking at ways that we can automate or digitalize aspects of financial literacy and provide some of the same basic information that those advisors provide one-on-one because some of it's repeatable, right? So we could take that and automate that, and then for those that want that more human interaction, we would still provide that. And we all know there are some fintechs that have taken a chapter out of the credit union book to say, hey, We need to back up the digital side with that human interaction, and they've done a great job. So if fintechs can do that, why can't we, right? Let's take that, cut it, and then rinse and repeat, as they say, right? And
Yep.
so I do think that evolution, and you bring up a great point, is going to be able to deliver some of those loan products um, much more efficiently, right, and effectively for members in the future. But we're still a community-based organization, and our members will use multiple platforms to bank with us today under kind of our banking for a greater good. And so even younger members and tech savvy members are saying they want to know that there's that agent or there's that branch there that they can go into if they have a question or want that advice. Now, we don't need the big footprints like we used to need. We can squeeze it down in a small office. We can do it through digital, right? Through an ITM, through video. So I think there are multiple strategies that institutions can utilize to deploy. And so our path to success has been to have a good digital platform, but also to offer those financial wellness centers, and then also to use automation when we can to automate and get members their money much quicker.
Yeah. Yeah. Well, like I said at the beginning of the podcast, you're known as one of the more tech forward and innovative credit unions. So, congrats on all that you've accomplished there on the membership
Thank you.
side and the products you've been able to deliver. What about on the shift to kind of the other side of the balance sheet and liquidity and managing risk? What's your view going into next year on like what do you have a new target share loan to share ratio? How are you thinking about liquidity? The last couple of years, it's clear banks and credit unions have it's been one of their top focus areas. What's going to happen next year?
Yes. So for us, and this kind of goes back into our M&A strategy recently. So when liquidity was tight, we deployed a lot of alternative sources of liquidity. So our borrowings increased significantly. We were looking at different sources of funding from what you would consider non-traditional or non-member funds in a variety of ways that we had never experienced at Great Lakes. So it was a great opportunity for us to expand our resources and our tools. And then, right, as the market changed and we reevaluated that balance sheet, loan to share increased, right? We looked at, well, what are some opportunities that exist out there from an M&A perspective where there were some institutions that had a lower loan to share but had excess deposits. And so we were able, through a merger and the acquisition of the branch, they sat on a lot of excess deposits. So we're able to merge in those entities, and within a year paid down our borrowings significantly. This is the lowest we've had in decades of borrowings.
Yep.
And then also paying down non-member deposits and then
Yep.
tier stepping down those rates that we were paying. So liquidity for us today is in a great position because of those strategic moves over the last 18 months. Now, as we look forward, it's really focusing more on the core deposit side and not so much those certificate specials and those type of products, offering competitive rates to our members, right? But really looking at building upon the loyalty of the member. The more they're willing to do, will we pay them a little bit more, right? If they're going to use multiple services. So really looking at kind of pivoting on the member side, whereas before we were focused on the non-member side because we didn't want to reprice everything, certainly. So I think as we look forward, it's by increased analysis and modeling. And so, yes, we have a budget. We reforecast every quarter. We're continually looking at what rates are doing, modeling that in. We're looking at liquidity intraday. So hourly, our accounting and finance team is looking at the inflow and outflow. And then if
Yep.
they see some trends that are alarming, then we react to that immediately. And so that has really helped us as well. And then we
Yep.
trend that information and really are doing, I think, a much better job through our ALM process of really modeling out different scenarios based on what we may hear economically is going on, and certainly based on that rate cycle as well. And so it I think it goes back to having more tools and resources available to us to make better informed decisions on how we're pricing and how we're looking at where are we going to get liquidity, and then what's flowing out and why is that flowing out, and then what do we need to change or pivot to internally to reposition ourselves.
Yeah, I mean that's one thing that was clear with SVB and First Republic is the old rules of a core deposit being core and sticky don't necessarily apply. Clearly, you have a different membership base than their depositors, but I think it like any credit union or bank has to have real time data and be monitoring real time things. It's just happened so much faster than it used to.
Exactly. And I think for us and many credit unions, it's really the focus on that data that we need. And we need to be able to bring that in and look at that member behavior and then also look at it from a risk perspective to say, all right, instead of treating everybody the same, we should be able to say, based on risk, we're willing to do this or this with you, where somebody else may not be treated the same because of the modeling, right? Based on that risk that we're seeing and based on that behavior that we have from that members. So for 2026, one of our data transformation projects is really to focus more on member behavior
Yep.
and modeling that out based on risk tolerance and risk
Yep.
buckets, and expanding that in to better serve the members by giving some of those members better limits than
Yep.
we would on other members that may be more riskier.
That makes a lot of sense. And so when you're building all this infrastructure, how are the conversations going with your regulators in terms of how you're thinking about that risk? Is it do they understand what you're trying to do? Is it an education process? How do you manage that piece? Because that's obviously one thing. We have a lot of bank and credit union management teams that listen to this podcast. And so that always, okay, well, what does it mean with with respect to my discussion with my regulator?
Yes, and so we're state chartered in Illinois, federally insured. So we're lucky we get a state of Illinois exam and an NCUA exam. And I think the key is having really strong relationships with your regulators so you can pick up the phone, you can exchange emails and say, hey, we're thinking about this, and this is what we're thinking about. Give us some input, or have you seen this, or this is what we've heard. And we typically get very good responses back from our regulators. I would say more recently from the NCUA side, just because of everything they're currently going through. We understand that it's a transition for many of those employees. And so it may take a little bit longer to hear back from them. But even on our most recent exam, we had great discussions on modeling and analysis and really being able to apply the modeling and analysis to our decision making, and then walking through how we want to utilize that information in the future, both to show progress on our balance sheet and our income statement, but also focused on how are we going to be relevant today and in the future to our members, and then how are we manipulating through the current market, right? And making sure that that model and that analysis is really true to what's going on in the environment we're operating. So it's also working with, our ALM partner, right? So
Right.
instead of having the static model that does nothing, right, being able to pivot and bring in factors that maybe we didn't even have to consider 3 months or 6 months or a year ago, which we didn't, right? And then being able to also have a board that can dig into that data and understand that. So as we're talking about strategic planning and initiatives and pivots in pricing or programs or rates, they clearly understand how to help support that and what to look at. And I think our regulators have done a good job with us on being able to say, here are the things that you want to make sure that you're considering when you're looking at building out these models or you're doing the analysis. And from the NCUA perspective, they have great capital market specialists that we've really enjoyed working with and have partnered with them even post exam. And that really helps our CFO, our accounting and finance team, because if you think about it, they're out looking at multitude of different organizations and can bring that experience full circle that we can learn from. Uh, and, again, relook at the model and change the model if it needs to be improved.
Yeah, it seems like partnership and engagement is the way to go. It's been a complete honor to spend time with you, Steve. You're clearly a leader in the credit union space, and I think other credit unions should try to replicate what you're doing in terms of technology, focus on the consumer, et cetera. So, thank you for being a guest on Consumer Lending Perspectives, brought to you by Upgrade. We welcome your emails to investor@upgrade.com on guests and topics, and be sure to subscribe for notifications about future episodes. Until next time, I'm your host, Jeff Bogan. Thank you.
Thanks for listening to Consumer Lending Perspectives. Subscribe for more expert insights and strategies from finance leaders, and share the show with your network. Until next time, stay ahead in the ever-evolving world of consumer finance.